Imagine I told you about a business that is legally allowed to create money out of thin air. Not earn it. Not borrow it. Create it. You type a number into a computer, and that number becomes real money that someone now owes you, with interest. It sounds insane. It sounds illegal. But it's the single most powerful business model ever invented. And it's hiding in plain sight on every street corner. It's called a bank. And by the end of this video, you'll understand exactly how a bank conjures money from nothing, why your deposit is never actually sitting in the building, and how the most regulated business on earth can still vanish in 40 hours. Let's break down the economics of owning a bank. So you want to own one. Most people picture buying a building, hiring some tellers, and installing a big steel vault. That part is easy. The hard part comes before any of it, because to open a bank, you first have to convince the United States government to let you. You start with the FDIC, the federal agency that insures people's deposits. And the first thing they'll tell you is that you need at least $20 million of your own money just to begin. Then comes the real test. You have to write a banking charter, a document up to 1,500 pages long describing every detail of your future bank. Regulators will study it for up to 2 years. If they approve it, you walk away with what is arguably the most valuable license in America, the legal right to hold other people's money and lend it back out at interest. Now, there is a faster way in. Instead of starting from scratch, you can buy a bank that already exists. Small banks usually sell for 1 to 1.5 times their book value, which means a modest bank might cost you $40 million. For that, you skip the 2-year wait and get the customers, the branches, the staff, and the license all at once. So either way, you're looking at $20 to $40 million, years of paperwork, and regulators living in your books forever. Which raises the only question that matters. Why would any sane person want this? Here is the answer, and it's the part most people never understand. When you deposit $1,000 into your bank account, the bank does not put that $1,000 in a vault. In fact, since 2020, the official reserve requirement in the United States has been zero. Your $1,000 isn't sitting in a box with your name on it. It's gone, working somewhere else. Now here's where it gets strange. When the bank lends money out, say a $200,000 mortgage to your neighbor, it does not go find that cash. It simply types $200,000 into your neighbor's account. That money did not exist 1 second earlier. The bank created it instantly with a keystroke. This is the secret at the heart of the entire industry. Licensed banks create new money every single time they make a loan. The money appears when the loan is made and disappears when it's paid back. And in between, the bank collects interest on money it conjured out of nothing. Let me show you what that looks like in real dollars. You keep $10,000 in savings. The bank pays you about $50 a year in interest. Then it lends that same $10,000 out at 7%. The borrower pays $700 a year. You got $50. The bank keeps the other $650 on money it never truly had. That gap is called the net interest margin, and multiplied across every account, it becomes a fortune. For JP Morgan, with trillions on its books, that simple gap brings in roughly $90 billion a year. But lending is only half the machine. The other half is the credit card. And this is where banks make their most ruthless money. Americans owe over $1 trillion in credit card debt, at an average rate around 21%. The banks themselves can borrow at under 5%. They charge their customers more than 4 times what the money costs them. Watch the trap. A customer carries a $5,000 balance. The bank says the minimum payment is $100. Sounds manageable. But at 21%, 90 of those $100 go straight to interest. Only 10 reduce the debt. At that pace, it takes about 10 years to pay off, and the customer pays nearly $7,000 in interest on top of the original $5,000. This only works because almost nobody pays in full. About half of all American cardholders carry a balance month to month, and that is the customer the bank loves most. Because here's the uncomfortable truth. A bank's most profitable customer isn't the rich person with millions in the vault. It's the ordinary person whose paycheck falls a little short. The bank makes its fortune selling people their own money back to them. And some bankers have taken this to places no one would put on a slide. In 2010, one of the largest banks in America admitted in federal court that for years, hundreds of billions of dollars tied to Mexican drug cartels had flowed through its accounts, disguised as ordinary transfers. The bank collected a fee on everyone and flagged none of it. The fine was a fraction of the money involved, and not one executive went to prison. But you don't need cartels to lose everything. Sometimes, a bank can do everything legally and still die in hours. On March 8, 2023, Silicon Valley Bank, the 16th largest in America, with over $200 billion in assets, announced it suddenly needed cash. 2 days later, it no longer existed. 40 hours. That is the new record for how fast a bank can die. It served roughly half of all venture-backed startups in the country. The moment its trouble leaked into private founder group chats, the panic spread at the speed of a text message. In a single day, customers tried to pull out $42 billion, nearly a quarter of the bank. In the old days, a bank run meant lining up at the window, which took time. Now it happens on a phone screen, all at once. And here's a detail you'll enjoy. The bank's CEO sold $3.5 million of his own shares 2 weeks before the collapse. A funny coincidence. So what actually kills a bank? A bank holds very little real cash. Most of your deposits are locked in loans that won't be repaid for 30 years. So if everyone demands their money at once, it simply isn't there. To survive, you follow a few brutal rules. Keep your customers diverse. SVB died because 90% of its clients came from one industry and panicked together. Be careful where you park the money. SVB bought long-term bonds that collapsed when rates rose. And watch who you lend to. After the world went remote, hundreds of banks nearly failed on loans against empty office buildings. And one final rule, the one that sounds least believable. The robber with a gun is a Hollywood fantasy. The real danger is already inside the building. Roughly 60% of all money stolen from American banks over the past decade was stolen by the bank's own employees. The loan officer writing fake mortgages, the teller skimming the drawer. The vault was never the weak point. The people with the keys always were. So how much do you actually make? A small community bank, after putting in your $20 million, might earn around $4 million in profit a year. By year 5, then sell for 4 times what you put in. Or you scale into a regional bank, 20 to 30 billion in assets. And after everything, you're looking at around $400 million in profit every single year. Not bad for an industry whose entire business model is selling people their own money back to them. So if you still want to buy a bank, remember the one rule the whole system runs on. The bank never lends you money. It lends you a number it created the moment you asked, and then it charges you for the rest of your life to pay it back.